Understanding the structure of your protection. As we continue building on E&O coverage and carrier expectations, this section focuses on the actual components of an errors and omissions policy. It is not enough to simply carry insurance. Brokers must understand how their policy works, what it covers, and more importantly, what it does not cover. This section connects directly to prior discussions on risk management by reinforcing that knowledge of your policy is just as important as having the policy itself. Coverage provisions. Who controls the defense? A typical E&O policy begins by outlining the coverage being provided. One of the most important aspects is that the insurer often retains the right to control the defense. This includes selecting legal counsel, choosing mediators, and determining whether to settle or continue litigation. This can be surprising to brokers who assume they control their own defense. The key takeaway is clear. When a claim occurs, the insurance company often takes the lead. Limits of liability. Knowing your maximum protection. Every E&O policy defines its limits of liability, which establish the maximum amount the insurer will pay for a claim. These limits apply to both damages and claim expenses. Understanding these limits is critical because they define the financial boundaries of your protection. Once limits are exhausted, the broker may be personally responsible for remaining costs. Deductibles. Your financial participation in a claim policies also define deductible amounts, which represent the portion the insured must pay before coverage applies. Some claims may have no deductible depending on the policy. Brokers must understand how deductibles apply because they directly impact out-of-pocket exposure. Lower premiums often mean higher deductibles. Risk is being shifted, not eliminated. Supplementary payments, additional coverage benefits. Many policies include supplementary payments for specific costs such as appeal bonds, trial attendance expenses, and post-judgment interest. These additional benefits can provide meaningful support during litigation. However, they vary by policy, reinforcing the importance of reviewing policy details carefully. Not all coverage is created equal. Territory. Where your coverage applies. E&O policies define the geographic area where coverage applies, typically tied to where the broker is licensed. For brokers operating across state lines, additional endorsements may be required. This is especially relevant in border markets. The takeaway is simple. If you operate in multiple states, your coverage must match your activity. Exclusions, the most important section to understand. One of the most critical sections of any E&O policy is the list of exclusions. Common exclusions include fraud, dishonest acts, trust fund mismanagement, bodily injury, discrimination, and certain business activities such as mortgage lending or syndications. This section defines what is not covered, making it one of the most important areas for brokers to understand. Coverage gaps are where the greatest risk exists. Extended reporting periods, protection. After the policy ends, E&O policies often include extended reporting periods, sometimes called tail coverage. This allows claims to be reported after the policy has ended, which is especially important when a licensee retires or leaves the business. Without this protection, claims arising from past transactions may not be covered. Real estate liability does not end when the transaction closes or when the license ends. Definitions. Understanding policy language. Policies include detailed definitions for terms such as claim, damages, insured, and professional services. These definitions shape how the policy is interpreted. Misunderstanding a definition can lead to incorrect assumptions about coverage. This reinforces a key concept. Insurance policies are legal documents, not simple agreements. Policy conditions, the rules you must follow. E&O policies include conditions related to premiums, audits, reporting claims, and cooperation with the insurer. Failure to follow these conditions can result in denial of coverage. For example, failing to report a claim promptly may void protection. Compliance is required not just in real estate practice, but within your insurance policy as well. Risk reduction techniques, lowering exposure and premiums. Many brokers work with their E&O carriers to implement risk reduction strategies. These include background checks, strong supervision systems, pre-listing disclosures, use of standardized forms, and ongoing education. These strategies not only reduce claims but may also lower insurance premiums. The connection is clear. Better systems lead to lower risk and better protection. Building a defensive brokerage. Systems that protect additional risk management tools include maintaining a strong policy manual, implementing incident reporting systems requiring proper documentation, and establishing clear client communication protocols. These systems create a defensible brokerage environment. If a claim arises, documentation and policies become critical evidence. Your systems are your strongest defense in both court and compliance. Real-world example: the cost of not understanding exclusions. Imagine a broker facing a claim related to trust account mismanagement. The broker assumes their E&O policy will cover the loss, only to discover that such claims are excluded. Without proper understanding of exclusions, the broker is left fully exposed. This reinforces the ultimate lesson: what you don't know about your policy can hurt you. How this section connects forward. This section ties together everything we have learned about E&O insurance, supervision, and risk management. Understanding policy components allows brokers to make informed decisions and build stronger, more compliant operations. As we move forward, we continue integrating these concepts into a complete brokerage strategy. The goal is simple: know your risks, know your coverage, and build systems that protect both. Online discussion question 1. Why is understanding policy exclusions critical for brokers? Answer: because exclusions define what is not covered, which is where the greatest financial risk exists. Question 2. Who typically controls the defense in an E&O claim? Answer: the insurance carrier, including selecting legal counsel and managing settlements. Question 3. What is an extended reporting period and why is it important? Answer: it allows claims to be reported after a policy ends, protecting against liability from past transactions.